Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is a growing salad restaurant company a good investment? In this video we will be analyzing if Sweetgreen Stock is a buy. Could Sweetgreen Stock, ticker symbol SG, be ready to surpass its all-time high? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Sweetgreen. Sweetgreen was founded in 2007 when three friends, inspired by a desire for healthier food options, opened the first Sweetgreen in Washington, D.C. with a focus on fresh, seasonal ingredients and customizable salads and grain bowls. Sweetgreen quickly gained popularity. They expanded their menu to include a variety of bases, proteins, and toppings, offering customers endless combinations. Today, Sweetgreen is a publicly traded company with a growing number of locations across the United States, and their headquarters are based in Los Angeles, California. Now let's look at the price action. Starting with the 1-year chart, we see that Sweetgreen had a CAGR of about 154%. Zooming out to the 5-year chart, we see that Sweetgreen had a CAGR of -12% over almost 3 years. It seems that Sweetgreen has finally hit its growth stride after bottoming in early 2023. Early shareholders are very happy. If we perform a backtest comparison of investing $10,000 in Sweetgreen versus the S&P 500, we find some poor results for Sweetgreen. In that comparison with the S&P 500, a $10,000 investment in Sweetgreen would have shrunk to $8,588. A -5.72% annualized return, versus $12,042, a 7.46% annualized return, for the S&P 500. This demonstrates underperformance for Sweetgreen. A Sweetgreen investment would have also been much more volatile, with a standard deviation of 94.19% versus 18.34% for the S&P 500. Sweetgreen outperformed the S&P 500 in terms of the best year performance, growing 143.19% versus 26.19% for the S&P 500, but underperforming on the worst year performance, falling 73.22% versus 18.17% for the S&P 500. In terms of maximum drawdown, Sweetgreen fell 75.50%. more than the maximum drawdown of 23.93% for the S&P 500. Surprisingly, Sweetgreen actually outperformed the S&P 500 in comparisons using the Sharpe ratio, 0.29 versus 0.28, and the Sortino ratio, 0.56 versus 0.41. Despite its underperformance in annualized return, Sweetgreen has actually been a better investment from a risk-reward standpoint. Very interesting. Now let's hop over to market share and take a look at Sweetgreen's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under restaurant and see that Sweetgreen is categorized as a fast food restaurant company. Expanding the fast food tab, we can see that Sweetgreen has the second smallest market share of companies listed in that sub-industry, but it does appear to be gaining market share. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Sweetgreen, SG, and see that the market share is 0.07% out of the publicly traded food, beverage, and restaurant stocks currently in the market. Sweetgreen attracts a small amount of food spend, but the company has been growing market share. The 5-year market share CAGR for Sweetgreen is 26%. This means that Sweetgreen's market share growth is rapidly outpacing growth in the wider industry. If we start in 2020, we see that the market share was 0.034%, 0.045% in 2021, 0.057% in 2022, 0.068% in 2023, and 0.072% over the trailing 12 months. The chart only goes up and to the right. I love to see it. Of note, Q1 2024 market share was shared because we are still waiting on some companies to report Q2 2024 earnings. Let's take a look at the fundamentals to learn more. Gross margin is 20%. This is a bit lower than some of their peer companies. Revenue has compounded at around 36% over the past 5 years and has reached over $649 million most recently. Sweetgreen's revenue had been growing very nicely and shows no signs of stopping. When we look at cash flow, we see a 179% CAGR since 2023 for operating cash flow, while capex has worsened at a 10% CAGR. As a result, free cash flow has improved at a 41% CAGR. I am very happy to see that Sweetgreen has started to reduce their capex spend. This means that the company can turn free cash flow positive faster and should be free cash flow positive sometime in 2025 if current trends hold. This means that the company will no longer be beholden to capital raises to fund operations. One negative to note is that stock-based compensation was $41.4 million over the trailing 12 months. That is almost 95% of operating cash flow. This is bad because even when Sweetgreen becomes free cash flow positive, they will still have another $41 million hole to dig out of before they can actually use their cash flow for something else besides paying executives. Weighted average shares outstanding have risen over the last 5 years, going from 16.1 million shares in 2020 to 112.8 million shares most recently. Sweetgreen has been diluting shareholders. The good news is that after the IPO in 2021, the share count has grown at a much more reasonable 1.6% per year. Now let's view return on invested capital. Return on invested capital has grown from -59% in 2020 to -15.1% most recently. While this value is still negative, it has been moving closer and closer towards a positive number. Hopefully this value will flip positive soon. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from -8 days in 2020 to -7 days most recently, Sweetgreen has essentially made a round trip in efficiency but still remains at a great value, indicating good performance. Last, let's look at Sweetgreen's debt. The net debt to EBITDA has actually decreased over time, going from 0.9 in 2020 to -1.7 most recently. However, with Sweetgreen being unprofitable, this means that the company has more debt than cash. Sweetgreen looks okay to me. In any event, should it be added to the watch list? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. Your continued support means so much to the food fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Sweetgreen. It is a restaurant company with a gross margin of 20%. The 5-year revenue per share CAGR is -22% and the 5-year free cash flow per share CAGR is 66%. With the gross margin being somewhat low, revenue growth was particularly hurt by the increase in share count, and free cash flow per share still remains negative. A return on invested capital of -15% is negative, which is bad, but is improving. Next, the cash conversion cycle of -7 days is good. Concerning debt, a net debt to EBITDA of -1.7 means that Sweetgreen is still unprofitable and has more debt than cash. So from a fundamental standpoint, Sweetgreen has a few good points and a lot of bad points. Now let's switch our attention over to valuation. Sweetgreen is negatively valued relative to the S&P 500 with a ratio of -1.3. The price to earnings growth, or PEG ratio, cannot be calculated because Sweetgreen is an unprofitable company. Sweetgreen is a very interesting company. They primarily sell salads, something you can get at any number of competitors including a local bodega, yet they have been rewarded by the market for subpar earnings. Sweetgreen's Q2 earnings were indeed mixed. They crushed revenue expectations, with revenue of $184.6 million versus $180.9 million estimated. However, earnings per share were -13 cents versus -9 cents estimated. Clearly, the market has rewarded revenue growth, but why? An Investopedia article offers some insight. Same-store sales increased 6%, with 5% attributable to higher prices and 1% to traffic mix. The company also benefited from an additional week in the 2023 fiscal year. Co-founder and CEO Jonathan Naiman said restaurant-level profit margins were up 500 basis points and Sweetgreen anticipates adjusted EBITDA profitability in 2024. For the full year, the company projects 23 to 27 net new restaurants, with same-store sales 3% higher. It predicts revenue of $655 million to $670 million. The news sent shares of Sweetgreen up 28% Friday to $16.36, their highest level since 2022. With Friday's gains, they've nearly doubled in value over the past year. Well, it seems like the market is pricing in continued growth, though I am a bit more skeptical that this will be the case. On the plus side, Sweetgreen is tapping into a major trend: healthy eating. People are becoming more conscious of what they put in their bodies, and Sweetgreen is positioned perfectly to capitalize on that. Plus, they've got a loyal customer base and a strong brand. I am definitely intrigued, though the valuation is still a bit high. For me, Sweetgreen is going on the watch list while I wait. Many thanks for watching. What do you think about Sweetgreen and rising revenue growth and even higher valuation? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.